Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Thinkorswim. And today, we're going to be taking a look at a tool on the Thinkorswim desktop platform. It's like a whole different type of chart for options traders. To me, this risk profile tool is kind of like the options trader's MRI machine, where they can take a trade and just look at its inner workings from all sorts of different angles, make all sorts of discoveries about that trade before they place the trade. So it's a very interesting tool, always sort of a crowd favorite. So I'm looking forward to this one. Before we can get into the details of the risk profile tool, let me first of all say hello to everybody who's chatting in out there in YouTube. Great to see all the familiar names as always. Hello there, Mighty Mouse and Richard, Rojo, Eva. Who else is out there? Let's see. Mark. We have Sandeep. Hello there. Everybody else, thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy that recording. It's a great way to watch these webcasts. But be aware that you're invited to join us in the live stream if you'd like to be here in that audience. This is a Wednesday webcast series, and we kick things off promptly at 2 Eastern. Now, I also want to let our live stream audience members know that Brent Moores is hanging out there in the chats with you. Brent's going to be keeping an eye on the questions as they roll in. And if I can't get to those, Brent's going to be there to help pick up my slack. Brent and I have been working together now for more than 20 years. The years just keep rolling, Brent. Yep. So Brent brings a ton of experience to this discussion. Thanks for having my back there, Brent. Brent and I would also like to issue an invitation to everybody listening to follow your favorite Schwab presenters on social media. It's the best place to connect with us when the camera's not on. So you can find Brent and me on X. You can find Brent there at Brent Moores CS. Give him a follow. You can also follow me on X at Cameron May CS. Now you can also follow me nowadays on LinkedIn. So you just go to linkedin.com/in, then /Cameron May CS will take you to my profile. You can give me a follow there. But let's get right into this. Kelly, it's been a while. Happy to be back. Great to have you back. Bill, welcome. Kevin and Becca, great to see everybody. Let's get a couple of important things accomplished first, though, because there's risk in trading and investing. So bear these important disclosures in mind. All corporate or issuer names and market data shown are for illustrative purposes only and not a recommendation, offer to sell, or a solicitation of an offer to buy any security. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. And investing involves risk, including the loss of principal. All right. So with that said, let's set a quick agenda for today's discussion. Today is learning all about how to navigate the risk profile tool on Thinkorswim. Now, this is a tool, it's very powerful, but I think there's also a little bit of a learning curve. Some people are intimidated by it the first time they encounter it. I just want to get us as comfortable with this navigation as possible. So we're going to be taking a look at an example option trade and using the risk profile to really look at its inner workings. How might this trade work out best? How much can it make? How much can it lose? What are the break-even points? What are the probabilities of those outcomes? What are the impacts of price and time and volatility? All these things. You can see how we're really going to be turning this thing and looking at it from different angles using the risk profile tool, but we have to know how to do that. So we're going to be doing it using a real-time current example. So let's go right to the Thinkorswim desktop platform. And our example trade today is going to be Cisco. I don't want to get too much into how options are traded. I'm going into this with a little bit of an assumption that at least the watcher has some experience with options trading. But just to set the sort of chart on a traditional stock chart view of this trade, let's say that our trader is looking at Cisco, and they notice that it has been advancing for 9 months or so, like just about every other stock out there. Obviously, not every stock has been going up like this, but Cisco and so many others have. But maybe our trader is looking at this recent pullback, and it's interesting to them that it's come down to our trend line. Maybe they see that as a possible price floor. It's also come down to a horizontal area of apparent price support. A previous price ceiling is sometimes assumed to become a new price floor, and at least in these very early days, it looks like that might be the case. So let's just say that our trader is bullish. Maybe they're planning a trade out for the 20th of February, and they think at least Cisco, despite today's pullback toward yesterday's candle bottom, maybe they think it's at least going to stay above, let's say, about the 72.5 mark as we move toward that February 20th expiration. So let's go do a bullish trade. And we're going to do this with an option strategy. And then we're going to use the risk profile tool to sort of break that strategy apart before the trader commits to the trade. All right. So here's going to be our trade. Let's go to our trade tab. Let's go out here to the 20th of February expiration. I'm going to stay on the call side of the equation. So let's stick with the calls. And how about we buy a $70 call and sell a $72.5 call, thereby creating what's known as a bull call spread, where the trader is really just looking for the stock to stay above the spread, in this case above 72.5, as we move toward expiration. So that's going to be our trade. Here's a quick way that we might construct that trade. Go up here where it says spread single. I'm going to change that to vertical, and it pairs up the 70 with the 72.5 strike. Then I'm just going to click on the ask price to create a buy order down here. Now, to keep this discussion as straightforward as possible, let's just do one contract. There we go. Buying the $70 call, selling the 72.5. It looks like it might be around $1.73, maybe as much as 205. Let's use kind of round numbers here. Let's say our trader is willing to spend, shall we call it $1.90? Let's do that. Let's kind of go halfway between the mid price and the natural in an effort for this trader to try to bump up the probability of a fill. Anyway, so this is the trade, spending $1.90 to get into a $2.50 wide spread. Our vertical spread traders know that if we're spending $1.90 to get into a $2.50 wide spread, it's leaving 60 cents over for profit. But we do have this very different style of chart that might help to give that trader, if we don't know those numbers, we can see those numbers displayed on the chart. So before we commit to this trade, what a trader might do is right click on this trade that they've constructed and select Analyze Trade. And what that does is it takes us to the Analyze tab. And if we go right to the Risk Profile tool, it brings up a profit and loss chart of this trade. Now, I've done something here deliberately to kind of throw us off course. I want our chart to look like this. And yet right now, it looks like this. That's because as we go to the Risk Profile tool, we have Cisco as the symbol that we're going to be analyzing today. But we have another trade already in place. In this account, there's an example long stock position of 150 shares of Cisco. And so this profit and loss chart is showing us the vertical spread that we're considering, but also the shares that are held. So I just wanted to show this to show that if you bring up this risk profile tool and it doesn't look like what we expected, check down at the bottom, make sure there aren't other positions sort of cluttering up the view here. So I'm actually going to uncheck the box for the Cisco shares. And now this is what I wanted that risk profile to look like. All right, so let's get acquainted with this risk profile tool. And as I do, let's see, we got over 100 people watching the live stream right now. Chat in just a Y or an N. Yes for, yes, I'm familiar with the risk profile. N for, no, I'm not familiar with the risk profile. So I know that we're going to have some risk profile fans out there. Not everybody is. Not every trader uses this tool. And as a matter of fact, in my presentations, I get requests to show this thing over and over and over again because it can be so handy. But to some extent, to me, it's kind of like if I were teaching, let's say, a grade school mathematics class, just trying to teach some kids how to do math. And they keep saying, hey, teacher, can you just give me a calculator? I know you want me to tell you what 5 plus 7 is. I don't know. Give me a calculator. I can just punch in the numbers and it tells me it's 12. Well, that's nice that you had a machine to tell you that it's 12, but it's better to probably know why it's 12 and how we arrive at that. So just so you know, in my presentations, very commonly, I kind of don't show this tool very often because it can slow down the learning because it's really so good at what it's intended to do, which is to tell us about the trade that we're expecting or that we're anticipating. Noodle brains, no, it's too confusing. Okay, that's one of the things I want to address. So it looks like plenty of yeses and plenty of no's for, yeah, it looks like we even have some saying, yes, I'm familiar. No, I'm not a fan. It's not for everybody, right? And yes, there can be a learning curve. It can be a little bit intimidating, but all we've done to this point is structured a trade and then load it into the risk profile. Now, if we've already placed a trade, we could just go to the risk profile and type in the symbol and it would automatically populate there. But in any case, let's acquaint ourselves with this tool. And as I've already said a couple of times, one of the primary functions is to show us a profit or loss scenario for the trade. So we have, by default, I have this blue line and I have this gold line. Now I realize the gold line is going to be a little bit harder for some to see, and down here there are going to be some numbers associated with that gold line. So I'm going to change that a little bit. I don't know if you knew that we could do this, but like as I look down here in the lower left corner, I can see if I squint, I see that says February 21, 26. Okay, yeah, that relates to that contract expiration. And it also says minus 190 as I point at this part of the chart, and it says $60 as I point at this part of the chart, but I can barely see it. It's a light orange on a light gray. It's not showing up very well. So I'm going to right click and let's change that. How about to a red so it stands out a little bit better? Does that help? I don't know if you knew you could do that. Just right click on the color you want to change and then you get the palette, change it. So now let's acquaint ourselves with this now red line and blue line. Red line, let's focus on that first. So in order to understand the line, we have to understand the grid of this chart. So what this chart is telling us is it's looking at this vertical spread that we've created, and it's showing us, first of all, the range of potential profit or loss. This happens to be a trade with a smaller profit potential than loss potential. So the grid's not going to go up as high as positive as it is negative. Now down at the bottom, pardon me, it has all these numbers. What are these numbers? Well, these are potential price levels for Cisco. And there's a number right in the middle. See where it says 7406? This vertical line is a visual reference point. We refer to that as a slice. It's slicing the chart right in half, and it's showing us where the current price of Cisco is. And then this what we know as the x-axis or the horizontal axis down here is showing us theoretical prices that Cisco might move to during the time frame of our trade. It could go from 7408 down to 73, 72, 71, or up 75, 76, 77. Now, and by the way, I'm gonna click on this right at the margin between our chart or our grid and the tools down at the bottom. We can click on that. As we hover over it, we'll see double-headed arrows. We can click on that, drag that up. It just allows us to see more down at the bottom at the expense of kind of squishing the chart a little bit, all right? But back to our chart here, we know that this is a bullish vertical spread. If we're familiar with buying calls and selling calls, buying a 70 and selling a 72.5 creates a bullish call spread. So if stock goes up, what do we expect profits to do? Well, they should go up or they should be capped. And specifically, this red line is showing us how this trade is likely to work out at different price levels at expiration. So that's why it says February 21st. That's the day after the last trading day. So if we look at the profit line up here, we can answer the question, I wonder how this vertical spread is likely to do at expiration if we go from 74.08 up to $75 or $76. Well, if I go to 76, it intersects with our profit line up here and displays down in the lower left. The outcome of that trade would be a $60 profit, setting commissions aside. Now, what if the stock didn't go up? What if it went down to 73 and we hit expiration? Well, that would still be above our vertical spread, and we'd still be at our maximum gain of $60. If we fall short of our vertical spread, though, let's say the stock starts to fall from 74 to 73 to 72. This is kind of, oh, and user says, can this risk profile be used for stocks as well? Yes, it can. Yep, it can. As a matter of fact, let me show you something at the end that might appeal to those who have maybe broader portfolios than just one individual option trade, okay? But with this trade, worst case scenario, for our vertical spread traders, they know if the stock falls below the vertical and we hit expiration and no more time for this thing to recover, that's where we have our maximum loss. And you can see that here, minus $190 below $70. Both those contracts expire worthless. The trader loses their investment, which in this case would be the $190 or $1.90 that they paid per share. So this red line is showing us maximum loss potential and where that loss might happen at expiration, maximum gain potential, and the conditions under which that maximum gain might be achieved at expiration. In between, though, we can see that if we're in between, let's say 72.5 and $70, well, we must not be at maximum gain. We must not quite be at maximum loss. We must be somewhere in between. So let's say, maybe the stock settles in at 71.5 at expiration. Let me just move my cursor over to 71. It's at 71.52. That's close enough. Look down in that lower left-hand corner, and this tool is now telling us we're taking this trade and we're turning it around with our MRI machine, and it's telling us, oh, in this circumstance, we would lose about $40. Minus 40 is what it says down there in the lower left. Right here is a red hash mark. What's the significance of the hash mark? Well, that intersects price at expiration with no money made, no money lost. That's the break-even point. So for this trade, if we spend $1.90 on the trade and we wind up $1.90 above the lowest strike, that would be at our break-even point of $71.90. Now, some of you are saying, I didn't know that's how vertical spreads worked. Well, that's why I would suggest we want to learn about vertical spreads first before we really become attached to this tool. But for those who use options on a regular basis, this can be a powerful tool. Great tool. All we did was type in the symbol, bring up our trade, and it's now telling us how much we can make, how much we can lose, the circumstances under which we might make or lose. There's our break-even point, lots of handy little things. But all of those assume that we allow the trade to go to expiration. And commonly, a trader thinks, well, what if my stock starts to go in the right direction very quickly, but even before expiration? What might happen at some other time? Bill, you see, great explanation. You see how to read the two lines? Yeah, Bill. So you're already moving on to line number 2, which is looking at a different date. It's not looking at expiration. By default, it's going to look at today. So today happens to be January 14th. That's when we're recording this webcast. So this is showing us profits, or these would be essentially projected but expected profits or losses if the price rose or fell. It's still a bullish trade. If the stock starts to move up, it's working its way toward profitability or making gains. But you can see that this has some work to do in order to hit break even for today. It needs to go from where it is right now up to this red dashed line. That's our break even point. Beyond that, so if our stock gets up to 76, 77 or beyond, we'd be profitable even just today. What if the stock fell today? Well, you'll see that that the line drops and it's showing this bullish trade is struggling if the stock is falling. Let's see. Eva says it's a good tool for verts. Would you suggest it for single leggers? Yeah, it could be helpful. Now, Eva, interestingly, for some traders, they may get beyond this tool. The tool is useful, but kind of like someone who has learned how to use a calculator, but they can do it in their head. Do we always bother to bring out our calculator if we already know the answer? Not always. So that's what you'll see me do very commonly in my webcasts. When we're bringing up a trade, once we get to a certain level of competency or familiarity with the trade, we might not need this tool, at least for individual trades, for single leg trades, for two leg trades. Once it starts to get a little bit more complex, the trader might need to go back to the tool. Or if we have multiple trades going on all at once and we're just trying to ask ourselves, hey, I have an iron condor on this and I have a vertical spread on that, and I have a single leg option on this stock, and I have have just a whole portfolio of trades. Wouldn't it be nice if I could just bring up a chart and the chart could estimate for me how the whole portfolio would do as the markets rise or fall? We could put the whole portfolio, shove it all in the MRI machine. Make sure it takes off all of the metals first, and then push it in the MRI, and then start turning the whole portfolio around. What happens with the market? What happens if the markets go up and down? What happens as time goes by to our portfolio? Anyway, yeah, lots of other things to discover here. Malo Simon says, what are the percentages on the top? I want to talk about those. All right, but let's finish our discussion of this line. Now, obviously, it's nice to have a line that can show us how our trade might do today. Well, what if our stock takes some time to move? Let's ask ourselves the question. I wonder how this trade would be doing. We're at 74.10 right now. I wonder how it might be doing next week if the stock has gone up to like 77 bucks. Let's turn the trade that way. Let's come down here to the little calendar. I'm going to click on that. Here's the 14th. Let's move everything, meaning this blue line, forward to the 21st. Now we can do that by selecting the calendar. There's another way that we can do that. I'm just going to click the plus or minus buttons here, because I want you to observe what happens to the blue line as we make those changes. This is now adjusting forward in time. So watch this blue line. And as an interesting reference point, keep your eye on this break-even point as I click the plus sign, advancing one day at a time. What you'll notice is the break-even line is moving to the left, while the profit line is advancing up. The loss line is advancing down, and what it's doing is it's getting to be closer and closer and closer, looking just like the expiration line. So if I go forward a week, there we are actually, January 21st, this is now a profit or loss, projected profit or loss as of next week. So if our trade, let's say Cisco has gone up to $77 by the 21st of January, well, we could just point at 77 and look over here in our profit or loss and how we doing. This trade would be up, let's get as close as we can. How about I move up a little bit so you can see the 77? There we are. Up about $16.50. And this is not an estimation. This is a very accurate projection of the changing values of these options using the algorithms that are used to actually create or price options. So if we happen to be correct about where the stock is on January 21st, this output is correct. Now, obviously, that's a big assumption, but the algorithm is precise. Yeah, Paul says this is now accounting for time decay. Pretty cool, right? Paul, built right into the chart. So lots of people have asked me, isn't there some way to chart options? Yes, this is the way to chart options. All right. Now, there are other things that can influence the pricing of options or the performance of this trade, not just price, not just time, because we can see an intersection now of both of those variables on our chart, but also volatility. As volatility levels rise and fall, as the expectations for a stock's price change, the value of their options will change as well. And there's actually a volatility adjustment that can be made here as well to show the projected impact on profits or losses. And this is the kind of stuff that, okay, I don't care how good you are at options, this one's tough to visualize. I know options really well, but I do not know the impact of time decay over the course of the week on Cisco. I know options very well, but I do not know how much rising volatility. I know the expected direction of the impact, but not the extent of the impact. So, yeah, Mark, we've been assuming that volatility remains constant. Let's not make that assumption anymore. Let me click on the little gear icon, and that's going to expose a volatility adjustment. So if you didn't catch that, by default, if you're looking around trying to find the volatility adjustment, it's not there. It's hidden under this customize gear. So I'm going to click on that. And this now allows us to make volatility assumptions. Not every trader makes volatility assumptions, but let's just say they think possibly, maybe they think volatility is going to rise over the coming week. So that impacts options prices. What should be the impact? What do you think? Well, this is a debit spread. It's basically we bought something, and when volatility rises, shouldn't it help out the profitability of long options? That's the theory. Let's see how much. Let me click on the volatility. I'm going to click plus. Let's start to dial that up again. And what's happening here? Uh-oh. In this case, it's not, because our stock actually isn't in the right position. Well, actually it is. In any case, but this is where we can explore the impact of volatility. And you'll notice our break-even point is moving, our profit and our loss is adjusting. Let's dial this down again. And you can see that line adjusting, and we can now say, yeah, I wonder, just to bring in a more complete question, I wonder how my vertical spread might do if price goes up by next week, but at the same time, volatility has shifted either up or down. We can explore those in that sort of a granular detail. Now, this is potentially an insightful tool. Could it be going maybe a step too far if a trader isn't quite that accomplished at projecting direction and timing and volatility? All right, I can forgive you for thinking it might be a little bit too granular, but it's still a nifty tool if a trader is feeling fairly confident about these, or just exploring the potential impact of being wrong or not considering these variables. So let's set this back down to, let's just go right to 0 again. There we go. As a matter of fact, once we've been tinkering around with these tools, if we've moved our date, if we've adjusted our volatility, we've kind of cluttered things up, there is a reset button up here. So I can come up here and just click reset. And it's saying, hey, this is going to reset the page to the system default. So it's going to set it back to the original date. It's going to set this back to 0. Are you sure you want to proceed? Let's click yes, and we're done. All right. Now, the other thing it brought the stock shares back into the analysis. So I'm going to take those back out. And now I want to answer that question. Who asked about the numbers up here, the percentages? These are probabilities that a trader might be interested in. What is the likelihood that maybe price falls within a given range on expiration? I wonder what the likelihood is for the trader for the stock to fall below 70 and we're just at maximum loss at expiration, or for it to be above 72.5 and we're at maximum gain. Or I wonder just what the chances are that we at least break even on this trade. So that's what these numbers help us explore. And they're related to these slices. All right. Now, the first thing that we need to do is adjust our date. So this is the 20th of February vertical spread. Let's go to the day after the last trading day. I'm going to go up here and crank this out to February 21st. And you'll see now we have some additional numbers there. Before we made that adjustment, it just says 100%, 0, 0, 0. That's because what these numbers are doing is they're looking at the current price of the stock. I'm going to switch this back out to February. I think it's going to be a little bit more meaningful way to learn this, okay? So let's go out here to February, go to the expiration. In any case, it's looking at these slices. The first one we already learned is the current price. The slice off to the right is just that price plus 10%. So 74.05 plus 10% is 81.46. The slice off the left is 74.05 minus 10%. So what these numbers are now showing us is whatever date we put up here is telling us, well, Cameron, there is about a 31.8% chance that come the 21st of February, Cisco is going to land somewhere between where it is right now and 10% above. There's about a 35% chance that it lands somewhere between where it is right now and 10% below. Now, it might go further. There's a 17% chance that it goes higher than 10%. There's a 16% chance that it goes lower than 10%. So these are all probabilities based on the times that we've selected and building in historical volatility of the stock. If we have a really quiet stock, probability is it's going to stay closer to home. If we have a more volatile stock, the probability to expand further out. All right, so now I got to ask, why is it 10%? Who cares about 10%? Well, the trader might not care about 10%. Thinkorswim, as good as it is not very good at reading minds. So it doesn't know what percentages are important to the trader. Fortunately, these slices, and again, they're called slices. I think this is the way that I think about it. It's because they're vertical lines that just kind of slice our chart up, now kind of sliced into quartiles. But let's say that our trader, instead of being interested in, what's the probability at expiration that we're above where we are right now or below where we are right now, I wonder what the probability is that the stock is below $70. That's our max loss. Well, there's about a 30% chance of that. Now, that is a meaningful percentage for our trader here. I'm about to enter into a trade that could flop. I could lose $190. What are the odds that that might happen? Well, there's about a 30% chance that on February 21st, we wind up below $70. But what are the chances we at least break even? Let me click on this slice, and I'm just going to drag it over. So we can do a click and drag. And let's position that one at 71.90, which is our break-even point. Well, there's about a 9.5% chance that we're somewhere between max loss and break-even, losing some money, but not all of the $1.90. So there's about a 40% chance of some kind of loss, either maximum gain or some loss, which means there's about a 43% chance plus 17. There's about a 60% chance that we will at least break even on this trade. Now, there's a final way that the trader might want to look at this trade, and that is, I wonder what the likelihood is of maximum gain. Let's grab this one, and I'm going to move this over here and position it right at 76.5. I'm going to try to be as close as I can, but intentionally, I'm going to leave that off by a few pennies. All right? 72.5, that's where the trader would theoretically need to be for maximum gain on this vertical spread. I got it close. So we're going to be off by a fraction of a percentage point, and since these are estimations of something that hasn't happened yet, for probabilities, might be close enough. The phrase that my dad would use is, hey, close enough for horseshoes and hand grenades and probabilities, right? Anyway, no, he wasn't an options trader. I'm just borrowing one of his favorite phrases and tacking on a little bit of my own. Anyway, there's about a 56% chance that at expiration, this trade is at maximum gain. The stock is above about 72.5. Now, somebody correctly pointed out, Becca says, you can also see more about these price slices down below. Yeah, I wanted to look at these price slices visually first, but we can also see those. If I click on this little caret next to price slices, a little caret pointing off to the right means there's something hidden here. If I click on that and the caret points down, it exposes more details. And in this case, let's click on our little margin again and drag that up so we can see our trade. We're squishing our chart. It's still perfectly serviceable though. But we can now see these things known as price slices, but in numerical form. So we've set one slice at 70. We've set another slice at 71.90, and the third one's at 71.65, and I just couldn't seem to get it where I wanted it. Well, we can also just change that right here. Let's just type in 72.50 and hit enter, and you'll notice what that did to our line here. Now, as we move those around, this is also showing us the impact on our trade. All right. Now this is going to be displaying, how are we doing with the stock at these levels? And you're probably saying, well, I know that, okay, Cameron. So theoretically, at expiration, if we're above 72.5, we should be at $1.90 or $190 in profit. And yet our PL open is showing us we've lost $34 at 72.5. That's because it's looking at a different, these numbers here are looking at this date down below. So we haven't gotten to expiration yet. These numbers are looking at the blue line. So let's play with our blue line again, and let's advance up. And as we go, you'll see these numbers changing. So let's say, let's keep going. And as I move, you'll just notice the profit or loss is growing. We're getting closer and closer to expiration. Randall saying, would you look at deltas at all? So Randall, that would be in the planning of the trade, not using this tool. Although, I mean, this can show us the anticipated deltas at different prices. I think that's maybe getting even a little bit further into the weeds. Not something that I want to explore necessarily today, since this is just the first introduction to this tool. But yeah, traders commonly will look at delta in the planning of their trade. I didn't here. I just made it based on a fairly straightforward technical assumption on a stock chart. All right, but yes, we can adjust time. We can adjust price, and we can adjust volatility and see the impact on our profit or loss scenarios here in numerical terms. So what I would suggest you do is play with these tools. Again, you can get in here, tinker around all you want, make the changes. If you get it all cluttered up and you just feel like, wait a second, I need to wipe the slate clean, you can just come right back up here and click the reset button. Now, one thing that I kind of failed to mention is this gray line. Let's do this. Let's go back here. I'm just going to hit reset, click yes. So we're back to square one. Let's get stock out of the equation here. And I'm going to set this back to our February expiration. All right. So there's our trade. Here's how it might be doing today. Here's how it might be doing at expiration. And then we have this gray area. What is this gray area? Well, this gray area is looking at how likely, if a trader were trying to describe the likelihood of the stock falling by February 21st within a given range of prices, where would that range go? Well, by default, we're going to look at a 68% probability. So in other words, if I rephrase this, if I were to say, hey, Cameron, take where the stock is right now and then draw me out an area that gives me a 68% probability that I have still captured the stock price on February 21st. 68%. Well, there's about a 68% chance that the stock is going to land somewhere between just below $82 and somewhere maybe just above $66.50. Very likely to land in that range, about a 68% probability. Why do we say 68%? Well, that's one standard deviation. It's a percentage likelihood that's commonly used in math. It's also commonly used in trading. All right. So for our trader who's just interested in probabilities, they might be looking at this and saying, well, there's a 68% chance that we're going to land somewhere in here, and look where my trade is. All right. Hanzo, are you asking me, do you work for Schwab? Yes, I do work for Schwab. I'm a senior manager of trading and derivatives education here at Schwab. And Brent works for Schwab as well. So you got two Schwab coaches here. Anyway, one final thing. We had a question come in earlier. It was from Eva, I believe. Eva asked, is this an appropriate tool? Is there any usage? Maybe with somebody else. is this appropriate for a stock trader? Well, yeah, I think stock traders, stock investors, there's a natural question that comes up. I think it all the time. Hey, the S&P just went up 1% today. I wonder how much my portfolio changed. Not everyone's portfolio is just going to move right in step with the S&P 500. If the S&P goes up 1%, some portfolios are going to go up 0.8% or 0.7%. Or if they're bearish, they may go down. Other portfolios, maybe that are more aggressive, might go up more than 1%. But wouldn't it be nice if we just had a tool here that could stick the whole portfolio in that hypothetical MRI machine that I was talking about, and we can start to play around with how does this portfolio perform if the S&P goes up and down. That is definitely a possibility as well. And that's done right down here where it says, you'll notice it's saying, hey, of your positions plus your simulated trades, are you showing them all or just a single symbol? Right now, we're just looking at Cisco. What if I wanted to look at the entire portfolio, weighted by historical volatility? That's what beta weighted means. I'm just going to change this little menu here to portfolio, beta weighted. And then the one other thing I'm going to do is change my benchmark up here. I'm going to change the symbol to SPX. So what this is now doing is it's showing us a profit or loss chart of the entire portfolio. In this case, it's the margin account in my simulated, in my paper money account. Now, what can you tell me without even looking at the positions within this portfolio? Yes, they're listed down below. I could scroll down through them if I wanted to, but someone who's not familiar with this current structure of this portfolio could make some pretty clear observations. And that is, looks like a bullish portfolio to me, because here's where the S&P 500 is right now. And if the S&P starts to move up, what happens to the profitability of this portfolio? It goes up. If the S&P goes down, what happens to the profitability of this portfolio? We start to lose money, and there's our break-even point for the portfolio. And let's see, was there another question that came in? Delta's higher. Okay, yeah, I don't know quite the context of that. Hey, all right, Doofy says, oh man, I've wondered about this for some time now. Here it is. Yeah, that's an interesting little tool. Now, how is it generating these profit and loss projections? Well, it uses something known as beta, which is a historical relationship between stocks and the S&P 500. If we benchmark stocks over time against the S&P 500, we might get some insight into how they tend to behave as the S&P goes up and down. Some stocks will tend to go right with the S&P. We say that it has a one-to-one relationship with the S&P, or in other words, it would have a beta value of 1. Some stocks will go up with the S&P, but faster. They'll go down with the S&P, but faster. That might have a beta value of more than 1. Or if a stock moves with the S&P, just not as fast in either direction, that would have a beta value of less than 1. But beta is that relationship of how a stock behaves compared to the S&P 500. And that gets built into this equation, built into this tool. And then we can do that across a whole range of different stocks and really start to give that trader or that investor a view into how their portfolio is likely to perform, generating either profits or losses as the S&P goes up or down. All right. Guys, we've covered a lot. I know that the first time you will get introduced to the risk profile tool, even though I think most people can get a sense for how powerful it can be, there certainly can be a learning curve. So this is one of those webcasts where you might want to go back and revisit it and just move forward a little bit at a time, digest what I've said, hit the pause button, move forward a little bit more, and just go at your own pace to really thoroughly understand the functions of this tool. So that's a nice advantage of the recording and the posting to the archives of these webcast series. So as I wrap things up, I'm going to give you a quick reminder of the educational resources that you have available to you from Schwab. Starting with, if you haven't subscribed to our Trader Talks channel on YouTube yet, do that right now. You can go down below the video stream right now and click on subscribe. That only takes a second, doesn't cost anything. But this is where you can find the playlists of previous webcasts. You can join our live streams, or you can even do keyword searches Maybe you want to learn more about the risk profile. So we can just type in risk profile. You're probably going to find other webcasts that I've done in the past. There's one that Brent did. Hey, look at that, Brent. And here's one that I did some time ago back in 2024. Another thing that Brent and I would suggest you do is to follow us on social media. So you can follow Brent and me on X. Brent can be found there at Brent Moores CS. You can find me on X at Cameron May CS. So there's my handle. And I'm very active here. And if you reply to one of my posts, I try to reply right back to you. I was just on this morning, just scrolling through, making sure I didn't miss anybody. If you reply with a comment, I comment right back. So it's a great place to interact with your favorite presenters in between the live streams. You can also now follow me on LinkedIn. So just go to linkedin.com/in and then Cameron May. So /Cameron May CS is my handle. That'll take you to my profile and you give me a follow there. But that's going to do it, guys. Thank you for all the thumbs up. That really is helpful. It gives us a nice pat on the back. It also gives us a boost in the YouTube algorithm so more people can find these webcasts. Looks like 111 people watching right now. And just exactly half. Excellent. 55 have already clicked the thumbs up. Thanks for doing that. Go enjoy the rest of our webcast through the rest of the day. I'll be looking for you in a future webcast of mine. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.